Welcome to HAVAN's Home Buying 101 video series, sponsored by BC Housing and Associate BC Incorporated. My name is Shayne Ramsay and I'm the CEO of BC Housing. In today's video, we will learn all about interest rates and mortgages with Alisa Aragon, Mortgage and Leasing Expert from Bridgestone Financing Pros DLC Mountainview. Welcome, Alisa. Something that's on everybody's mind are these record low interest rates. What does this mean to potential first-time home buyers?
This is a great question, Shayne. Definitely, I would say this is a great time for first-time buyers to get into the market as well, because qualifying rates have come down to 4.79, which means that home buyers will be able to qualify for a little bit more than they used to before.
Thanks, Alisa. What about for existing homeowners?
Definitely with lower interest rates, if right now you have a mortgage, it's definitely worth exploring the option to see if it makes sense for you to refinance. For example, I had a client, they have a mortgage, they got it about 3 years ago, and their interest rate is around 3.64. When I did the calculations, however, the penalty would have been about $9,000. So when I did the numbers, they would have, because to pay the penalty and legal fees and everything else, they pretty well would have been back to a mortgage amount of the same amount of what they originally had. So it didn't really make sense, even though their monthly cash flow was going to improve. They were going to save about $150 every month. But at the end of the day, it just didn't really make sense to do that. But it's definitely worth going through that exercise and seeing if it makes sense or not.
A common question for all homeowners or home buyers, should they be locking in for longer term mortgages?
Your typical mortgage term is typically 5 years. You can definitely look at a 7-year or a 10-year mortgage. Because interest rates have been low, lenders have reintroduced the 7 and 10-year mortgages. Rates are slightly a little bit higher. However, you really need to look at what are your plans with your home. Are you going to be there for a longer period of time or not? So pretty well look at those options and see if that makes sense for you.
Thanks, Alisa. Another important question for home buyers and homeowners is, should they consider a fixed or variable rate mortgage?
That's a great question, Shayne. There's a difference. Fixed rates are pretty well fixed, meaning that you're going to be paying the same amount of money in your mortgage for the term of the mortgage. So if it's 5 years, for those 5 years. So regardless whether interest rates go up or down, that's what you're going to be paying. Fixed rates are also dependent on the bond market. So when the bond market goes up, then interest rates go up. And when the market goes down, fixed rates go down. But you're definitely locked into that rate for that term. Now, there is a difference with variable, and there's also adjustable rates. So the difference with that is they're both dependent on prime rate and the overnight lending rate by the Bank of Canada. So with variable rate, what happens is if prime rate goes up, it means that your payments are going to remain the same. However, the problem with a variable mortgage means that if prime rate goes up, then your payments are going to remain the same. However, you're going to be paying less principal and more interest, which in turn your amortization period is going to extend. So instead of reducing it, which is what people want, their amortization period is going to increase. The difference with adjustable rate means that if prime rate goes up or down, then your payments will go up or down depending what happens with prime rate. So obviously you'll be making the same payment, the lower payments or higher payments depending on what is happening. As to which one you should take, it's definitely a personal opinion and decision, and it depends what's best for you. Again, because what you're going to be more comfortable with. Are you going to know that X amount is going to be the same amount you're going to have for the next 5 years and you don't care what happens with interest rates? Or are you okay with the flexibility of going up and down? Another option would be as well is to consider is what are you going to be doing with this property that you're buying? Because the penalties are a lot higher with a fixed rate compared to an adjustable or a variable rate. With a fixed rate, you pay typically the greater of the interest rate differential, which is what interest rate you have at that moment compared to what rate is what you have and how much is left on your term. And then the other one would be what is your or 3-month penalty interest. With an adjustable, the only penalty you pay is 3-month penalty interest. So it's definitely a lot lower.
Thanks, Alisa. What are your thoughts on whether COVID had an impact on interest rates?
That's a great question, actually. Yes, it definitely did, because because of the unprecedented times that we're in, and like I mentioned before, typically the bond market has an effect on fixed rates. So if the bond market went up, then fixed rates went up, right? And vice versa. However, with COVID, one of the things that happened was because lenders and banks really rely on money being deposited from businesses and people, individuals, from their paychecks. And because that wasn't happening, that's the cheapest money they actually use to fund mortgages. But because there was a reduction on funds coming in, what they had to do in order to keep funding mortgages, they actually had to go to investor financial institutions to actually get more money, which was costing them more money. So what they had to do is interest rates went up because of it. So it didn't follow the typical projection, but because of unprecedented times, they had to borrow money and it cost them a little bit more money. That was more in the beginning, so around March, April. However, now definitely rates have come down, and with the Bank of Canada reducing prime rate as well, definitely interest rates have come down.
Thanks for that. I'd like to move on and ask you, what else should a buyer be aware of when they're looking to secure a mortgage?
It's interesting because most people really focus on interest rates, and it's not really about the interest rate. It's about finding the best mortgage with the best rates and the best terms. And the reason why I say that is because it's really looking at the overall mortgage, such as how the mortgage is registered. So there's two different ways. One of them is called standard or conventional, or the other one is collateral. So conventional, for example, means that if you're going to be, your mortgage is going to be $100,000, that will register for the actual amount, which would be $100,000. With collateral, it means that they will actually register it at a higher amount. So if it could be 50% more or even greater. So if your mortgage is $100,000, they will register it for $150,000. The reason they say that is that, well, if you ever need to refinance or you need more money, you still have to qualify. You don't have to pay legal fees. However, at the end of your term, if you want to transfer to a different lender, you do have to pay legal fees. So that is one of the things that you need to really consider as well. And penalties. There's the way penalties are calculated are very different in the way that typically, as I mentioned before, is with a fixed rate is the greater of the interest rate differential or 3-month penalty interest. However, most banks calculate their penalties. When you look at their mortgages, you see a posted rate minus a discount, and then the actual contract rate. The contract rate is what you're actually going to be paying in your mortgage. That's the interest rate. However, when they calculate the penalty, they calculate it based on the posted rate. So the posted rate could be 5.34, for example, and you're paying a mortgage of 2.19, which means is the penalty is being based on 5.39, right? So that's a huge difference. So that could be a $15,000 penalty. While other lenders as well, they're called, say, monolenders. And monolenders are also federally regulated. And most of them are, or some of them are actually backed by banks as well. And they don't have the huge penalties because what they do is they calculate the penalty based on your actual contract rate. So would you want a $15,000 penalty or a $3,000 penalty? That's a huge chunk of your equity, right? So again, it's figuring out what is the best mortgage for you and what it makes sense for you. So again, don't just focus on the interest rate because even though you might be going with an adjustable rate or a variable rate, what can also happen is there might be an additional penalty of 2 or 3% on top of your typical penalty, right? So make sure you really look at the fine print and you ask a lot of questions because that's definitely something that can actually really, ding you in the end.
Thanks, Alisa. I'd like to ask you now, what is the First Time Home Buyer Incentive Program and where can people find out information about it?
This is a program that the federal government introduced. And what it is the government will actually help you if you're buying an existing home up to 5%, so they'll match your 5%, or if you're buying a new home construction, then it could be up to 5 or 10%. The thing with this incentive program is that the government actually becomes on title with you. So essentially you're buying the home with the government. which is something that you really need to watch out and see if it makes sense. Yes, the reason they actually introduced this program is to make it more affordable in a way that the mortgage payments would be a lot lower and more affordable for first-time buyers to be able to do that. You do have to be a first-time buyer to be able to do that. So in that case, that is one of the things that is a challenge. And as well as you're also sharing in the equity of the home. So if the equity were to go up, then whatever equity surplus there is, you are going to have to share it with the government as well. So I would be really cautious about looking to see if that's the right program for you. I'm not saying it might not be, but again, as I mentioned before, make sure you read the fine print and really know all the details about it, because there's different things that you need to consider. There was a program that the BC government introduced a few years ago. They did cancel it since then, and I would say that was actually a better program then than this one, for sure.
Thanks, Alisa. I'm going to put you on the spot a bit. When do you expect interest rates to rise again? And as such, what level of urgency do you think a home buyer or homeowner who may want to take advantage of low interest rates should have?
I don't know, to be honest. I have no idea. Because typically, we have our fall market and our spring market, and typically, in the beginning of the year, rates go up. But again, we're in such unprecedented times that we don't know. We don't know how long rates are going to be low and for how long. As I mentioned before, in, March and April, rates did go up because banks had an issue with liquidity. So I don't know what's going to happen in the fall. So I really don't know what will happen. Definitely prime rate and the overnight lending rate, the Bank of Canada is not foreseeing to increase it for the next couple of years, like I mentioned before. So I do see variable rates staying low. However, one of the things that might change might be also the discounts that lenders are offering. Because when you have a variable or adjustable rate, the discount remains the same, but because rates have come down so much, the discounts are much less. So you might have like prime minus 40, while probably a year ago you could get prime minus 80, right? So again, we don't know how long these rates are going to be low, especially fixed rates. So I would suggest that if you are a first-time buyer, you definitely should look at getting into the market now, considering that also the Bank of Canada reduced, so you're able to qualify for a little bit more. And but one thing that I would suggest, which I mentioned to quite a lot of my clients, is don't only look what is the maximum amount you actually qualify for, but what you're comfortably paying on a monthly basis, because you don't want to be house rich and money poor and not be able to do other things, right? So that's really, really important as well. So yeah, so I would say if you're looking or thinking of getting into the market, definitely this is a good time, because there's great product out there, great homes. And why not start building equity in your home for yourself instead of actually paying somebody else's mortgage?
Thanks, Alisa. I wonder if you can comment on the high ratio lending now that CMHC has changed their criteria.
Shayne, I'm glad you're asking, because this is a very good question and I get a lot of people asking me this. Pretty well, when you're buying a property and you're putting less than 20%, by law, you have to pay the mortgage default insurance. This insurance premium is added onto your mortgage. It depends on how much down payment you're putting, between 5% up to 19.99%. So the premium depends on the percentage, depends on that. So it's added onto your mortgage. It's only added on once. And what happens is CMHC reduced their qualifying ratios, their debt service ratios. So what that means is when you're looking at applying for a mortgage, because of the stress test, you're qualifying right now, it's at 4.79, right? Because that's the qualifying rate. So what happens is there's the GDS, which is the gross debt service ratio. And that means it's your mortgage payments, your strata fees, if applicable, property taxes, and heating. And that cannot exceed, depending on your credit, between 35 to 39% of your gross income. So that's before taxes. The other calculation is the TDS, which is the total debt service ratio, and that is the GDS, which I just mentioned, plus any other debt you have, such as credit cards, car payments, loans, lines of credit. And that, again, depending on your credit, cannot exceed more than 42 to 44% of your gross income. So what CMHC has done, they have actually reduced the qualifying, regardless of your credit, to a GDS of 35% and a TDS of 42%. There are two other insurance companies. CMHC is pretty well run by the government, and it's a government agency. And then there's also two private companies, which is Genworth and Canada Guarantee. Typically in the past, when CMHC had made a change, Genworth and Canada Guarantee follow suit, but not this time. So that means that when you apply for a mortgage, the lender will actually decide where they send your application for the insurance premium. So again, if the ratios don't work, most likely they might send it over to Genworth or Canada Guarantee, which in turn, it means that you're still going to qualify for the same amount that you were before. So that's a little bit misconception that people don't understand, because they just think because CMHC made a change, that means automatically they're going to qualify for less. So hopefully that answers the question.
Yeah, thanks, Alisa. It answers the question. I want to change gears a little bit now and ask you about reverse mortgages. What do they look like in the current market scenario?
That's a great question. A few years ago, there was a program called equity lending, which was you could actually take equity from your home and use that. And as long as you showed other investments that you had, you can use the equity. However, that program pretty well disappeared in the last few years. So there's no such thing as equity lending. So reverse mortgages is a great option for you to do it. Because in order to qualify for a mortgage, you pretty well have to qualify with your income. And typically, when you have a pension, your income's fairly low, so you wouldn't qualify. So reverse mortgages is an option. And essentially what you're doing is you're using the equity in your home to get funds as a lump sum payment, or you can do it monthly or quarterly, however you decide, or a combination of both. And then you have access to those funds.
Following up on that, who can qualify for a reverse mortgage?
In order to qualify for a reverse mortgage, you have to be 55 years or older. It has to be your principal residence, and pretty well whoever's on title has to be living in the home. So those are the typical qualifications. It's funny, sometimes clients ask me, it's like, oh, would reverse mortgage be an option? And I said, well, the thing is, you're actually too young, so you don't really qualify for one. So funny enough, that's sometimes what happens.
Given the high cost of housing, Alisa, can a reverse mortgage be used to help your children buy their first home?
Absolutely. One of the things that is happening is a lot of parents are actually giving their children early inheritance to be able to help them buy or get into the market, right? So that's a great way to help it. So if you don't qualify and you're in a pension and your pension's not high enough, a reverse mortgage is a great option. You can use only up to 55% of the equity in your home, and that is based on an appraised value. So that means you'll still have equity later on.
For reverse mortgages, what are some of the risks involved, and what should we be aware of?
I guess like anything, there could be some risks. So you really need to make sure you're making an informed decision and it is the right decision for you. What I would say is once you get into, most times people use reverse mortgage is because they're not able to qualify or be able to access the equity from their home. Again, because there's not such a thing as equity lending, is in order to access those funds, you have to income qualified. And when you're in a pension or you have your investments or income from your investments, it might be quite low. So that won't be enough money for you to qualify. So sometimes if you do get into a reverse mortgage, it might be really hard for you to get out of it because you actually have to find another option in order to be able to access those funds, right? So that would be one of the things that I would look at. You could look into private lending, which they also focus on the equity of the home, but that actually costs a lot more money and might not necessarily be the best option for you.
What happens if I already have a mortgage or a line of credit against my home?
You can definitely use a reverse mortgage as well, as long as there's the equity in there. So the mortgage or the line of credit will be paid out, and then it would be replaced by the reverse mortgage. So for example, if you have a full line of credit of say $250K and you qualify for a reverse mortgage up to $300,000. So what they'll do is they'll pay out the $250K mortgage and then just give you a $50,000, or you have access to a $50,000 equity in your home, right? So again, you can take that as a lump sum payment, quarterly or a combination or monthly. So it's really up to you. And then you do have to be still living in the home, whoever's on title. And if one of, say, the persons passes his way, as long as the other person is still living there, you're able to maintain the reverse mortgage and you don't have to move.
Thanks, Alisa. What are some other strategic financing options that exist that buyers can consider to enter the market?
Obviously, because qualifying has become an issue because of the stress test, one of the things that parents are actually doing is helping the kids get into the market. So that's a way of giving them early inheritance. So they're giving them substantial down payments towards the purchase of a new home, which is great. Or as well, what they're doing is they're co-signing with their child. So they are going to be on title. Most lenders right now are not really just wanting parents to be guarantors. They're wanting them to be on title. So one way that you can do that is there's two ways which mortgages get registered. So you can register a mortgage as joint tenants, meaning that pretty well if there's two people, they own half and half. Or you could have it as tenants in common, which means that, for example, the child could be owner 95% of the property and then the parent only 5%. Because it is not their owner-occupied property for the parent, there will be capital gains on that percentage. So it could even be 1% if that's the case, and then the child on 99%. However, that allows the flexibility and the ability for the child to get into a home. Well, not really a child anymore at that point, I guess. But definitely that helps them out. And I actually have several clients that have actually helped their children be on title, so they do qualify, and they're using their income, the parents' income, to help them qualify. So that's one of the things they're doing. But at the same time, if there is a mortgage, the parents have a mortgage and property taxes, those have to be included into the calculations to debt service the mortgage.
Thank you so much, Alisa, for sharing your market knowledge. If you would like additional information, you can check out Alisa's website. If you found this video useful, check out my other industry expert interviews in the HAVAN home buying series at Homebuilders Association Vancouver. Thank you for joining us today, and the best of luck in the search for your new home.